Hi, welcome to the Asia Climate Capital podcast. In each show, we tackle the business and finance trends of the energy transition and decarbonization in Asia, with the capital markets in mind. Please do send us comments or topic ideas to the Asia Climate Capital podcast at gmail.com. This will allow us to make sure the content is useful and relevant to you as well as other listeners. Welcome to episode 4 of the Asia Climate Capital podcast. Today is Sunday, 27th of March, and I'm your host, Joseph Jacobelli. Today actually is going to be an audio blog. It's from an article that an op-ed that I contributed to the Energy Industry Times. And if you want to have access to this op-ed, all you need to do is to go to the Energy Industry Times website at TEITIMES.com, TEITIMES.com. So today's audio blog is about Putin's war and the short and long-term impacts on Asia's decarbonization. Now, the horrific invasion of Ukraine by Russia's President Putin has created a humanitarian catastrophe, killing thousands and displacing millions. It has also worsened the global economic environment, with prices of many commodities, including energy commodities, sky high, just as the world was recovering from the effects of the COVID-19 pandemic. But how is Putin's war affecting the Asia-Pacific region's path to net zero emissions by the middle of the century? Certainly, the energy transition will be negatively impacted in the short term. Yet, there are several mid to long-term positives. The global energy transition outlook was actually bullish after COP26 ended back in November 2021. Global climate action had gained renewed momentum despite the lukewarm short-term economic expectations that included lower global GDP growth, higher inflation, and increases in interest rates. In January 2022, the IMF had expected that global inflation would gradually fall thanks to diminished supply-demand disparities and the monetary responses from major economies. But then, on February 24, Putin's war worsened the outlook. The conflict may lower GDP by 1 percentage point and raise global inflation by 2.5 percentage points, the OECD wrote in early March 2022. So obviously now this outlook may be a little bit more negative. Now, in the short term, meaning over the next 12 to 24 months, the macro environment negatively impacts the pace of the energy transition in the Asia-Pacific region in 4 ways. The factors include high materials inflation, slower projects build-out, the impact of the higher interest rates, and possibly income disruptions for some of the new projects. Now, the first short-term negative is higher inflation, which will raise the prices of the material used to build the equipment that produces clean energy. Some of the materials used for the construction of wind turbines, for example, include aluminium, chromium, concrete, copper, plastic, steel, zinc, etc., according to a study by EIT Raw Materials. A second short-term effect is that the pace of construction of new energy generation facilities may slow due to supply chain constraints. Specifically, the supply shortfall of the key raw materials will impact the production of renewable energy generation equipment, such as wind turbines, solar cells, as well as related equipment like solar inverters. This, in turn, will slow the construction pace of new clean energy projects. A third factor is that the high inflation will also mean interest rates will rise, probably by several percentage points on average in the next 12 to 18 months. The increase will raise the construction costs of projects. In the Asia-Pacific region, clean energy projects such as utility solar power generation installations are 50 to 80% debt financed, typically the higher end of the range actually. All of the project's expenditure is upfront. So if during the first few years of the life of the project, interest rates rise sharply, it will affect its return on investments. Finally, this poor macroeconomic environment may impact the income of some clean energy projects that have only just recently signed long-term power purchasing agreements. If a renewable energy project concluded a long-term power purchasing agreement a few weeks or months before Putin's war started, it may have locked in a fixed price for the power sold. And this could see it stuck with that price despite a rising cost. And that obviously, again, would negatively impact the returns as well. Arguably, the short-term negatives are a global phenomenon, not just necessarily just Asia-Pacific specific. The key difference between the region and the rest of the world is that Asia-Pacific is the single largest energy consumer in the world, and it is building more clean energy capacity than the rest of the world combined. It also means that the effect on the region will be amplified. The short term may be rather dim, but the medium to long term, namely beyond 24 months, is actually quite bright. The first factor is that key energy markets in the region will accelerate the energy mix shift as they seek to enhance energy security, cut pollution, and control energy price volatility. Goals that can easily be achieved by reducing their reliance on fossil fuels-based energy. Secondly, they will also more aggressively seek newer, clean, and sustainable solutions. Finally, these efforts will be supported by the capital markets, which increasingly seek green and sustainable opportunities. So I'll just go through these four factors very quickly. Asia-Pacific's reliance on fossil fuels is just massive. The region accounts for 45.5% of global primary consumption in 2020, the biggest consumer by a massive margin. And that's based on BP's statistical review of the world energy published in July 2021. The second largest share was actually North America, with just 19.4%. The region's liquefied natural gas accounted for almost 71% of the world's total, 71%, and is also rapidly increasing. It also accounted for 80% of global coal imports in terms of oil. Asia Pacific imported 58% of the world's crude oil and 46% of global oil products. This makes the region highly exposed to energy commodities supply disruptions. Also, it is obviously sensitive to commodity prices fluctuations, as many of its energy markets do not have mechanisms to pass through the higher energy costs to end users. An example is Asia's liquefied natural gas price volatility. Consumption has been growing at a massive rate and is expected to continue to rise sharply in the coming decade. The compound annual growth rate between 2009 and 2019 was 3.3%. We don't use 2020 because it wasn't really a representative year due to COVID. This compares to Asia Pacific, 3.3% compound annual growth rate. Middle East was about 3.1%, Africa's was 2.1%, South America was 1.3%, and North America 0.6%, and Europe's was negative 0.2%. Now, the price of LNG in the region over the last couple of years not only has sharply increased, but also has been highly volatile. This year, through the 15th of March, the lowest LNG Japan-Korea Marker Platts future price was $20.53 per million BTU. The peak price was 2.5 times higher at $51.77 per million BTU. This massive volatility hurts the important country's balance sheet, the utilities' profits, and much more. Some of the markets, such as South Korea and Taiwan, do not, for example, fully pass through the commodity increases to end users. The issues presented by fossil fuels means that there will be a continued drive in most of the region toward new clean energy solutions, as many markets are rich in innovation. China is at the forefront in the exploration of the viability of newer solutions in areas ranging from vehicle-to-grid charging systems to carbon capture, utilization and storage, or CCUS. China is not alone. Singapore, for example, has been aggressively pursuing energy storage systems, or ESS, research and pilot projects to support a major increase in solar capacity. This includes exploring the deployment of floating energy storage systems, something particularly important given Singapore's, obviously, land resource scarcity. Another example is Australia, which is devoting a large amount of public and private resources to the development of cost-competitive green hydrogen. Actually, examples in the region simply abound. The final factor is the capital markets. In the past few years, capital in the Asia-Pacific region has faced the same green pressures as the rest of the world, and progress has been impressive. Private capital interest in renewable energy projects in the region has gained significant momentum. In the equities markets, the region has seen a trickle of energy companies spinning off their clean energy assets, as well as new private firms listing. There's also been news of special purpose acquisition companies, or SPACs, dedicated to clean energy, seeking to be listed in Hong Kong and in Singapore. In the credit markets, the issuance by Asian governments or corporations of green bonds and other related bonds such as sustainability-linked bonds is sharply accelerating. In the lending markets, the largest financial institutions in the region are gradually adopting guidelines to stop lending to fossil fuel-based projects and raise the amount of green lending, and also structure net zero emission portfolio strategies as well. Finally, according to a recent survey by the Asia Investor Group on Climate Change, or AIGCC, most asset managers have or are in the process of launching climate-related investment solutions. So that's it for my thoughts on Putin's war, short and long-term impact on Asia's decarbonization. I trust you found the conversation useful. As always, feedback is really key, and in order to make the content useful and relevant to you and other listeners, please do give us some feedback. Also, please like the podcast in whatever podcast app you use, and send us your comments, your thoughts, your ideas for topics anytime at the Asia Climate Capital Podcast at gmail.com. That's the Asia Climate Capital Podcast at gmail.com. Thank you.